James Knightley is an economist at ING Financial in London. He's joining us now. James, the big question for investors has been when the Fed would move on rates, but the latest data suggests it won't be anytime soon, correct?
Yeah, that's right. I mean, the latest consumer confidence numbers were a real setback, if anything, and do suggest that the consumer situation is not as rosy as a lot of people have been hoping for, and that growth is therefore likely to be weaker, and as direct results, interest rates don't need to rise anytime soon.
Well, how much can investors actually expect Bernanke to say about the timing of any rate move?
Well, I think at best we're going to get another comment about interest rates being kept low for an extended period. Interestingly, James Bullard, the St. Louis Fed president last night, was stating that extended period you can take to mean at least 6 months. So I think, to be honest, Bernanke is probably going to be a little vaguer than that. But in general, we'd expect him really to focus on the desegregation between monetary policy in regard to boosting the economy, such as interest rates and quantitative easing, and those that were designed to protect against systemic failure, such as changes to the discount rates, which we saw last Friday.
How much do you think we'll see of market reaction when those programs go away at the end of March, supporting the housing industry? Are we going to see a big jump in market rates and mortgage rates?
It's difficult to say. I mean, at the moment, it's well anticipated, if you like. So you would be expecting sort of the market to be gradually moving in any case. But I think, the data on the housing market could yet change the situation. If we get further weak numbers like the consumer confidence figures we got yesterday, then that could start to build expectations that we could see a further expansion of QE, which perhaps would be offer more market support.
Yeah, we saw Mervyn King suggest that the Bank of England hasn't necessarily gotten out of the business. You expect a similar pledge from Mr. Bernanke today?
Yeah, I don't think he'll rule anything out. That's certainly the Bank of England line, is that, while the data has been showing gradual improvements, there are still risks out there, and that does still warrant the possibility of keeping the door open to further policy initiatives. And I certainly think Bernanke is going to probably do something similar.
Well, as investors get set up for the day, what asset class is most vulnerable to his testimony?
I think certainly risk assets are looking still pretty vulnerable. We've got lots of more situations going on in Europe, more Greek strike action coming through, concerns about fiscal austerity. So if we get more negative views on the macro outlook, that could further undermine equity markets, I suppose.
How about currencies? We have seen a big move in the euro over Greece and some anticipation that the dollar will get support from the Fed. If he doesn't go beyond extended period today, does the dollar fall back again?
I think there is perhaps a little bit of a risk there, but certainly our medium-term view is more dollar positive. I think the Eurozone fundamentals are looking even flakier than they are in the US, with fiscal austerity coming through much more prevalently this year. And I think the risks are that we see much more corrective action in Eurozone this year, which again suggests that both growth is likely to outperform in the US and interest rates are likely to be raised a little bit sooner in the US, and that should perhaps be dollar supportive.
All right, James Knightley, economist at ING Financial Markets in London. Thanks for being our guest this morning.